get the first corporate conversation going. Ramkrishna Forgings has reported a good Q1 quarter. The company has seen its net profits rise by over 50% along with a strong operational show. The board has also approved an acquisition worth 200 crore rupees recently. Naresh Jalan, the managing director at Ramkrishna Forgings, is here with us on the show. Thank you very much, sir, for joining in. First, if you could tell us what was the total quantum of order wins in the current quarter? In Q4, I remember you had given us a figure of about 775 crore rupees, plus there was that large 12,000 crore Indian Railways order. In the current quarter, what's the order win and the pipeline? Sir, you're on mute. If you could kindly unmute yourself.
I think, good morning, and we basically had got a good significant railway business from European Railways, and I think that's the first entry of RKFL into the European markets of the railways, and that's the biggest order win for the first quarter. But the order wins which we have done in last year have started showing traction in this year, and I think we are going to have at least 50 to 60% from that order book getting into revenues in this year.
What's the size of this European rail order that you got?
It's about close to 5 million euro.
5 million euro contract.
5 million euro order. So, Mr. Jalan, can you tell us, going forward, if we look at FY24 as a whole, then will this be the only key critical big order on the railway side, or are you looking at more opportunities as well? How much revenue would you want to see coming from this part of the business?
I think this year we are looking at almost 5% of our revenue coming from railways. And I think there are a lot of new negotiations already in pipeline. And I think with the coming days and months, we'll be able to have a lot more information about our foray into the railways, a significant portion of our business getting from Indian Railways.
Okay, so 5% of your revenue this year from the railways and building up from there. Okay, so let's talk about the bread and butter business X of the railways as well. Overall, as we can see, your volumes have been up about 25%, I think, in the first quarter. So give us some more color on what the growth trends are like, and can you maintain this sort of a run rate for the rest of the year as well?
I think we are pretty confident as guided for the full, during the last call. We are looking for at least 15 to 20% volume growth for the full year. And I think we'll be doing better than that. Current market shows extremely robust status. So I think both in terms of exports and domestic, we are seeing a lot of traction. So going forward, we feel that we will be able to maintain the guidance and get better than that.
Okay, 15 to 20% volume growth as a whole. Can you give a split between the local business and the export business?
So I think local and export business both will continue to do at the 60-40%. 60% is going to be domestic and 40% is still going to be export. A percent here and there, but we feel that the mix is going to remain the same as 60-40.
Okay. So your margins have been at about 21.5%, slightly lower than the Q4 margin levels, which were above 22%. What's the outlook on margins going ahead? If you could give us a sense that are there any levers which can help push up your margins? Anything that you see dragging the margins down?
No, I think we are in a pretty stable margin regime, and I think we will be able to maintain these margins, and with the traction in the volumes coming in and the kind of volumes right now we expect at least 50 to 100 basis points for the whole year to do better than what we have done in this quarter or previous years.
Okay, so FY24 margins will expand by 50 to 100 basis points, aided by the volume leverage, right? The leverage which flows in on the back of strong volumes. Recently, your rating has also been upgraded by ICRA and India Ratings, I believe. Can you tell us the overall, how much will it bring down your finance cost? What does your debt currently stand at?
I think our debt levels is same as we closed in the last quarter, about 8 to 10 crores higher than last quarter. But I think this will mitigate over the full year, and I think we are pretty remaining at the same. We are looking at close to a 1:1 debt to EBITDA by FY25, and that's the outlook which we are working with. And in terms of interest cost, I think this quarter interest cost has peaked out for us. And from here on, you will see moderation in the interest cost going forward.
Mr. Jalan, what are the capacity utilization levels you'd be working on as of now?
So in the existing plants, I think we are almost at 83% plus, and I think we have already informed the exchanges. Additional 23,000 tons of capacities have been put in production on 18th of July, and I think probably by the end of this quarter, additional 22,000 tons of capacities are going to be in place. And if you see our presentation, I think an additional 25,000 tons, which is under installation, will be up and running by end of the full year, by March 24. So overall, I think additional of this approximately 70,000 plus tons of capacity, we are well geared up to go to the next level of company's ambition to grow the company at the level of 15 to 20% every year for next 3 years.
Okay, so the bulk of the capex is coming on stream by March, end of FY24, you're saying?
Yes, by March 24, I think almost all the capex will be through.
Okay, got it.
Okay. So just to confirm, the European rail order is 5 million euros, right?
Approximately 5 million.
Approximately 5. Okay, because we need to correct that number which is going on the screen right now. It's a 5 million euro contract. And getting back to the debt levels, in Q4, it was about 1,200 crore of gross debt and 1,100 crore of net debt. That's the number which still stands today.
Yes, still stands today.
Okay.
So just a quick word on the railway business. I believe you are in a consortium with Titagarh Wagons for supply of forged wheel. This is an Indian Railways order, which is just over 12,000 crores. So typically, how is the consortium structured? What is your share of this total order value? And would you be bidding in future as well with Titagarh, or would you be, what can we expect in terms of more bidding on the railway side this year?
No, I think it is on a case-to-case basis. Both of us have an extremely good relationship, and we continue to leverage each other's capacity in growing the business for the Indian Railways. I think this is a stepping stone towards a bigger aim of supplying rolling stock components to railways. And I think this is right now a 51-49% railway order. We are the lead partners right now, but we are working on equal terms with Titagarh in terms of forward and new businesses which we are looking to bid to.
Sir, just any big picture plans? Have you set out a 3-year, 5-year vision for the company where you want to see it in terms of top line, margins, return ratios, or in terms of even your geographical, your export contribution? Can you give us some long-term markers?
I think in terms of our aspirations is to touch 25% margins by 2 years. And that's what we are working on standalone. And the acquisition which we have done is basically aiming to those numbers. We have done this acquisition also. Basically, acquisition brings a lot of flexibility in the system to being only a component manufacturer to get into assemblies. This acquisition will help us to get into higher trajectory of margins by supplying more of assemblies to B2C segments. And that is the whole idea to get into it. And in terms of top line, I think company continues to look at 15 to 20% growth year on year, and we are building capacity on a stable way and using more of free cash flow available with the company to augment this capacity rather than taking on debt to grow this company.
Okay, thank you very much, Mr. Jalan, for joining in. That's Ramkrishna Forging. The stock is up 6%. And I think in the last 1 year, the stock has practically doubled. The company's aspiration is that they will continue to see a 15 to 20% top line growth. Railways will start contributing more and more, and margins, they're looking to push up margins 50 to 100 basis points in the current year, but get it to that 25% band in the next 2 years. That's 12-month. It's up 200%. Phenomenal, the kind of gains that we've seen in Ramkrishna Forging. Get into a break. On the other side, we'll put the spotlight on metals. Manisha Gupta joins us next.